What's up guys, I'm Harry and welcome to my finance channel. This video is going to discuss some of my reasons and thought process as to why I'm keeping some of my money uninvested and out of the markets this year. So I have a decent amount of money that I want to invest that's currently in my bank. It's money that I've saved up from the last couple of years of working. I'm currently a full-time student, so I have no income besides dividends and my maintenance student loan. Essentially though, this money isn't growing. There are three options that I have for how to invest this money. Option 1 is to invest all the money straight away as a lump sum payment into my portfolio. Option 2 would be to pound cost average my money into the market. So this would be investing a small amount every week over a long period. Option 3 would be not to invest this money at all and wait for the next market crash and then invest all the money at the market bottom. So essentially timing the market. Firstly, I want to rule out option 3. Unfortunately, I don't have a crystal ball to look into the future, so I can't predict when or if there will even be a market crash. Also, commonly the largest market gains are directly after the largest market losses. So waiting for the market bottom will usually result in missing the largest market gains. Option 1, investing the money straight away, would typically be the best choice. This is as the market tends to go up more than it goes down, and lump sum investing favours a bull market. This is as you get in at a lower price. Vanguard published a study showing that lump sum investing outperforms pound cost averaging 64% of the time after a 10-year period. This research was done using a 60-40 stock to bond ratio and investing in the US, UK and Australian markets. What I'm doing is option 2, pound cost averaging my money into the market. So I'm consistently investing a relatively small amount of money into the market every week, and I have the money to do so all year. This approach to investing is favourable during a bear market or where there is a lot of market volatility. This is as it allows you to buy in at a lower price if the market falls, whereas with lump sum investing you are locked in at the price which you first bought in at. I'm doing this as I think there is a fair chance there will be a market pullback in 2021. I'll explain why. There is a lot of uncertainty around the future that I don't think is priced into the markets, especially the US markets which are currently trading at all-time highs. The uncertainty is regarding the pandemic. I think the risk is too high that there will be a serious mutation to the virus which will cause significant delays in getting the population vaccinated. If this happens, there will be a reasonably significant pullback to the market, although nothing like what we saw in March 2020. Even if that doesn't happen, the US markets have recovered extraordinarily well, significantly higher than the pre-pandemic highs, and the S&P 500 is up over 20% since November 2020 alone. It won't surprise me if there is a correction at some point later this year. Cathie Woods, head of ARK Invest, has recently said that she expects a market correction soon and has encouraged her investors to keep some powder dry to capitalise if it does. By pound cost averaging into the market, it leaves me with enough cash available to take full advantage of any market pullbacks if they happen. However, if there is no market pullback, then I am still gradually adding to my portfolio, so we'll get the gains. If you're invested in the stock market, let me know in the comments what approach you're taking and what you think will happen to the markets during 2021. Thanks guys for making it to the end of the video. If you enjoyed it, please do hit the like button. Doing so really helps with the YouTube algorithm. I'm posting videos here weekly, so if you're interested in investing or finance related content, please do subscribe and turn post notifications on. Enjoy the rest of your day.